So Aditya, we have 2-3 minutes for our disclaimers. So as we always do, as and when you are comfortable, we can start with that. And then we have a couple of questions which had already been asked by the audience. And so one by one, we'll be going through those questions. So you and Sajal sir, whosoever both can add to similar question. And if you haven't covered, then obviously we can pass that question.
Yeah, sure. And I can see my colleague and teammate and dear friend Aditya Chheda on the spaces as well. Welcome, Aditya. Um, Anyways, I think I at least make my disclaimer and then we'll wait for Sajal Bhai to make his disclaimer. So, guys, we'll be discussing various themes, various talks. We'll be taking names probably and also suggesting if valuations are expensive or cheap in our opinion. But all of that, you should assume that these are all opinions and just opinions. You should not act on them. You should definitely consult your financial advisor before you invest. And you should always assume that we have vested interest. I am a equity fund manager with Incred Asset Management. I own some of these stocks or many of these stocks in the portfolios of my clients. And hence, I will have a biased view. I will have a vested interest in talking up some of these stocks. And I will also have a biased view and a vested interest in talking down some of the stocks that I don't own. So hence, please take everything that we say with a big pinch of salt and do your own diligence before you invest or before you sell anything. Please consult your financial advisors at all times.
Thanks, Aditya. And then, as we always say for everyone, always take the conversation as a starting point so as to aid your understanding. And definitely, your set of questions, good set of questions, and antithesis pointers are always welcome so that we can also do away with the blind spots or something which we were not able to figure out. And that's always a two-way communication, as Aditya and Sajal always say. So definitely we try to add value best in our capacity, but it is fair to assume that whichever companies, businesses or stocks would be discussed, so there would be a fair side of biasness, or you can say, you can fairly assume vested interest also, not a problem. For that reason, we sincerely ask you guys to take due diligence and give it a priority so that you should not make any false or wrong decisions to say, and it's always wise to consult your financial advisor for any financial decisions. So Sajal sir, I can see you sent your request, so in case you received, please join us.
Yeah, hi Prince, can you hear me?
Yes, sir. Hi.
Good evening.
Yeah. Hi Aditya. Hi, good evening. Hi friends. Hello everyone.
So Sajal,
I just sorry Aditya, you're saying something.
No.
yes, sir.
You should make your disclaimers, I think, before we start.
Yeah, exactly. So I heard Prince, you stated the disclaimer. So I will start with a short disclaimer followed by about 10 minutes kind of a monologue. Hopefully, that might help. And my humble request is, if during the monologue, if you disagree with anything, please do put that in the comment reply section. Let us know what you think, because no one is perfect, and we all make we all have our own blind spots, etc. So adding to Prince's disclaimer, I mean, this is nothing more than an open discussion, and one must do their own due diligence and detailed independent analysis. On average, it will take you about 100 days or 100 hours rather, if not 100 days, per sort of name that we illustrate or mention in this session. And if you don't have 100 hours per opportunity to invest, then there is no harm waiting for a 20-25% drawdown. And then even if you get that 25% drawdown, if you buy that stock because you think that we know more than you do, then put a 5% stop loss as soon as you buy, so that your capital is protected. Happy to answer any stock specific query after answering the questions that people asked on Twitter under the link shared, and we kind of repeated that link multiple times, so that gave everyone plenty of opportunity to ask questions. But please give us your background and fundamental understanding of the business behind this stock, so we know your current level. Um, for a beginner, as far as fundamental investing is concerned, a SIP in index ETF or exposure via a diversified mutual fund is usually far better approach than attempting direct investing. And again, this is for beginner. If you have been in the market for 10-15 years, you have seen 2-3 down cycles, serious drawdowns, then you probably should know what you should do. So given the context of today's discussion, the role of guidance and prediction in wealth creation, it's good to remind ourselves that as the future is uncertain and unpredictable, and that's true for life in general, let alone investing. So a calm and composed mindset, process discipline and patience, all those attributes are needed to survive. I have actually lost the count of number of times companies such as Dishman, Biocon, Zydus, Aurobindo, Strides Pharma, work hard to Laurus and Indoco, and many other companies, and not just in pharmaceutical, across industries, they gave guidance and they disappointed. The problem with pharma is that you neither control the regulatory outcomes. So Jubilant Pharmova, again, Spokane and Montreal, you don't know the outcome of the regulatory audit, and you also don't know what your competitor is doing. It's such a secretive business. So there is absolutely no point giving any sort of guidance. Why can't analysts do their own guidance? They're paid to do that, right? That's their job. Is the job of the analyst to issue guidance. And why can't management focus on running the business rather than running the guidance show? That's my honest opinion on this never-ending game of guidance and predicting the uncertain future and then failing. Obviously, if you try to act like a turkey, then Thanksgiving will happen one day. So the idea is to survive and not get obliterated, guys. The basics are same as ever. Allocate at least 4%, if not more, in a good quality asset, managed by good quality people, and try to accumulate them at a valuation that makes prediction pointless and almost redundant. So if I buy something and not overpay, then time is my biggest friend. And news flow, noise, and day-to-day volatility, it doesn't mean anything to me. I mean, a lot of volatility has happened in the last couple of days. I've not done anything. Yeah, I've added some because I took opportunity. If market is giving me an opportunity, I will seize it. And I always keep some cash, especially in the run up to a major event, because I know what happens in such a major event. I've seen so many cycles and so many general elections. So anyway, so my template to survive in a random and unpredictable world is simple. Have a large margin of safety. Margin of safety is often misunderstood as low valuation alone. Of course, valuation is important, but if I want to own an asset for few years at least and exploit the upside of random events much more than the downside, then I also want a high quality team of people running the show. And I want a business that has actually transformed over time, has certain inherent competitive advantages, and has passed the Lindy test of sustainability. I don't want a fragile management and I don't want a fragile business, even if the valuation is dirt cheap. So even if something is at one time book value, I may do a 6-month trade, but I will go with a very fixed window that, I'm buying this asset at one time book. The moment I get 3 times book, I will exit and I will put a trailing stop loss because I know how momentum works in cyclicals. So in section 3 of my book, for those who have read it, there's a long explanation around hurricanes and tornadoes. These can develop at any point. And we usually don't get a warning informing, that they are coming, their arrival. They never pre-announce. So hence margin of safety is my sole antidote, right, against randomness and mistakes. And I will make plenty of mistakes, but I want to make small mistakes. not big ones. So either a hurricane or a tornado, when superimposed on the net margin of safety model, so graphic 9.1 in the book, is the way I tend to approach margin of safety. So for the benefit of everyone, let me summarize that model quickly. So margin of safety in management, what is that? So I don't know a management, I don't want to partner with a management who has never made any mistake. They are too fragile and they can collapse without warning. So my kind of management and leadership is one that makes new mistakes, hopefully small mistakes, takes feedback, uh, learns and pivots to make a new performance high. And stock is a slave of business performance and not the other way around. So management fragility is, by the way, sector agnostic. So management conduct, management disclosures are very strong lead indicators. A management that is giving guidance and failing and giving guidance and failing is very fragile. And if I give that management some feedback and they course correct. So Loras as an example. Or Indoco, if you look at the Q4 transcript of Indoco, they have stopped giving guidance. That's a thumbs up. Good. Just continue with that practice. So um, my whole idea is that follow the fail fast and approve slow principle by starting with a soft signal of out. So if I see a management giving guidance, my soft signal is out, and I will wait for a counter confirmatory evidence, right? Uh, and and the whole point is to avoid zero in any segment of the thesis: industry, tailwind, management, business, valuation. Because if you get a zero in any of these 4 or 5 key parameters, your net result will be zero, even if you wait for 5 years. So Bodal Chemicals as an example, right? Uh, so avoid zero in any segment of thesis, even if you are buying 100 shares, let's say, or 50 shares or 10 shares. Always ask yourself, am I willing to buy 100% equity and become promoter at the current enterprise value? So if DV is at 100,000 crore market cap today, if I'm having all the capital in the world, will I be willing to buy the whole business if it's available? That question must always be asked regardless of how many shares you are buying. So that's on the management and the valuation kind of, and I'll dig some more around the valuation. If you need a microscope to justify valuations, then you're already late. Uh, don't get harmed by random events. Not to be a turkey, right? So always question low price to book, always question low price to sales, always question low ROCE, as well as the high ratios. Again, high price to book, why is it high? High price to sales, 20 times, 10 times, 15 times, 25 times, the 21 IPOs, right? As an example. And actively investigate the catalyst for mean reversion. So mean will be different for different businesses. So something may be good value even at 8 times price to book versus another asset which may be at 3 times book and still be very, very, very expensive. So we have to take price to book in the context of the business and the sector, of course. And mistakes will happen. So sell fast and buy slowly if possible. Um, Concrete guidance is pointless. How can management commit to sales and margin targets with so many unknowns and known unknowns? So Johari lens in section 3 for those who have read the book, right? And finally, the margin of safety is not just in valuation and the management. Margin of safety is also in the business to an extent. Yes, management will ultimately transform the business. So Laurus today is not same as Laurus of, let's say, 5-7 years back, or Deepak Nitrate. And the Deepak Nitrate that I bought in 2016 is not the Deepak Nitrate that we see today. And this will, with all honesty and integrity and disclosure that I am invested, 5 years out, Deepak Nitrate will not be the Deepak Nitrate that we see today. So the business has to continuously evolve and avoid narrative fallacy or the halo over stocks. Um, because something is done well in the past cycle doesn't mean anything for the future, because market is always rewarding the forward rate of change. What has happened, what has gone, what's in the past is done and dusted. You don't get rewarded for prior year profits. It's the forward rate of change. So a loss making business is stop making losses will be rewarded. So when you get from bad to good, you could become a multi-bagger depending upon what your starting valuation was. Pessimism to optimism is a fantastic 10-bagger. Many cases we have seen in the past. The chemical sector, many hundred baggers. Why? Because they started with pessimism, below book valuation, below price to book. And then they went all the way to 10, 15, 20 times price to book. So the IPOs were coming at 30, 40 times price to book, even in certain cases. So, um, what I mean by business sustainability, overconfident or arrogant leadership with poor execution track record. That's a no. Chronic high debt plus low free cash plus, limited control on pricing and volumes. That's a classic fragile business. Import alert on multiple plants at any or any extreme event that can react with that high debt and cause explosion. So business is sitting on a high debt, they get USFDA import alert. So work hard as an example. Game over. So margin of safety is in saying no to many curveballs, and believe me, you will get many curveballs. So have the patience to wait for a really juicy full toss, and we win by not losing too much. Small losses and frequent losses are inevitable. Accept small mistakes with humility, move on. What's not acceptable is the large magnitude losses. It's the magnitude and not the frequency of those losses that will kill you. And something that can kill us is complete avoid. So Russian roulette, no. Even if the probability of win is 99%, I would not play a Russian roulette because I know the magnitude of downside. So survival is paramount, right? Example again, that Bodal example, right? So in a mad bull run across the chemical sector, I could have accidentally bought Bodal chemical instead of Deepak nitrite. In fact, the price of Bodal, if I'm not mistaken, was almost double of Deepak at one point in 2016. So Bodal was 2x of Deepak, price-wise, stock price, right? So that's where this anti-fragile management framework is so important in the overall margin of safety. A Bodal hasn't compounded. Same sector, right? Chemicals. But Deepak has, Atul has, Naveen has, SRF, so many examples. So management, you can't go wrong on management. Your margin of safety, someone must have seen margin of safety in Bodal at that point in time, right? What's the net outcome? Nothing. So before we start the Q&A, a bird's eye view of how I see valuations at the sectoral level. And please, if you disagree with any of this, let us know your feedback in the reply. Consumption, yes, I'm bullish on consumption, both discretionary as well as rural consumption such as autos and FMCG. But I'm more inclined towards discretionary at the moment, because my thesis is that the per capita income of this country will only rise regardless of the government. India is getting richer. People will have more money. They will spend more on healthcare. They will spend more on capital goods, upgrading their standard of living. So discretionary consumption, I'm definitely bullish. And PSUs, so PSUs across the sectors, expect underperformance. I mean, that's my expectation, or at least sort of time correction as valuations have appreciated pretty sharply. But we can't say everything is expensive even within the PSU space. So PSU as a whole, as a universe is expensive, but not everything is expensive. So PSU banks as an example, there are still few decent quality banks, decent balance sheet, and there is business continuity as far as the government is concerned. So hopefully, they are still not as expensive as some of the other pockets like defense and capex related spaces within the PSU basket. Then cement, I mean, infra proxy, so mildly positive on cement, but a 20% fall from here will make them more attractive. I mean, as per my framework or template, at least. Then metals, not bullish, and I've said this openly the other day. And the metals have had a huge rally. I was positive few months back. I even answered that clearly in one of the Q&A sessions. But ultimately they are global cyclicals. You have to be very conscious about the valuation that you are paying. So metals, I'm not bullish. In fact, I'm kind of getting increasingly bearish because I also track global metals, Rio Tintos and everything. So if metals is such a golden trade, then the Rio Tintos of the world, they should also have been making new highs. Why it's only happening in India? So I'm a bit skeptical there. So that's my call on metals. Textiles, uh, good value, but Western markets are in a coma, especially the EU. So I don't expect much to change on the textile side. There may be few exceptions, but they will not be the rule. And I'm super bullish on manufacturing across GMP and non-GMP chemicals. Pharma, biosciences, custom synthesis, absolutely bullish on manufacturing. Positive on branded healthcare, such as branded pharma, hospitals, etc. But given the recent run up in the valuations, we are not where we used to be, let's say 2 years back. And I would like to seek your opinion on this, Aditya, and please, you also guys, you understand healthcare because we have been having these spaces for good 2 years now. So hopefully where the valuations were 2 years back and where they are. So let us know what you think about branded healthcare today. And last but not the least, one another space that I track is sugar. So agri commodity that still dances to the tune of, policy flip flop from government. And despite all the chatter over the years that, these sugar companies are now kind of quote unquote biorefineries, rather than just a commodity play, government role is still visible. Um, Not an investment advice, but I like two managements in the sugar space. So one is Triveni, the other one is Balrampur. I have tracked these managements, transcripts, interviews, etc. And so these are my sort of go-to managements as long as the valuations fit my criteria. And again, my criteria will be different from yours, so this is not an investment advice. But sugar remains a highly fragile agri commodity. So you got to be careful. Chemicals I've already included within manufacturing, GMP and non-GMP. So I said I'm positive. I think that's about it. I would like to hear your opening remarks, Aditya, and then I think we can open it up for the Q&A.
So I am bullish on 5 pockets within the Indian equity space today. Number one, I think we are in sync. That's consumption, both discretionary and non-discretionary. I think if you look at the makeup of the Indian GDP growth for the last few years, and I mean post-COVID. So post-COVID, uh, other than the ultra luxury basket, consumption has actually seen a material slowdown. And that could be largely because of inflation and higher interest rates. So, the ability to pay EMIs and the ability to have higher disposable income has declined because of higher inflation and higher interest rate, dangerous combination for a consumer. And I think that is where most consumption stocks have seen a tough patch in the past 2 to 3 years. And I think going forward, next 2 to 3 years could be different. We could see lower interest rates, lower inflation, which will allow higher disposable income and the ability to take more leverage, which will drive consumption. On the PSU pack side, I would not go with PSU banks at this stage. One, obviously, valuations have run up. Yes, there are certain good quality banks available at reasonable valuations in PSUs, but I will still not touch them. I think PSUs, NPAs are at a cyclical low. And I don't really see a material change in the way PSUs function. Name lending is still widespread. Corruption to a certain extent is still widespread. To add to that, given what has happened in the elections and the possibility of a coalition government, I wouldn't be really very surprised if the upcoming budget in July is much more populist than the budgets we have gotten used to over the past few years, because one party had absolute majority. So, you could see a more populist budget in July, which could include some impact on PSU banks and the way lending is done and the way, waivers are given, etc., etc. So I would not probably play that. I will play IT at this stage, because if the budget is positive and, IT stocks are fairly come off, the valuations, they're actually all gone crazy during COVID and post-COVID, but they have fairly come off, from those high valuations. Uh, and they continue to remain down because of the commentary of most managements that mostly discretionary spending on IT in the developed markets of US and EU are slowing down. um, that might change if the US Fed cuts rates. We just saw the first rate cut from Europe this morning or last morning, I think, a 25 bip cut. And I think if the US Fed also, cuts rates in the future, discretionary spend in IT could come back, and that would help some of these IT stocks to recover. To add to that, if the Indian budget is populist in nature, I would expect the fiscal deficit to widen, which would impact the currency rate between India and US, and hence the rupee should depreciate. And if the rupee depreciates again, IT is one of the sectors that would benefit from that. So that's the second bucket I would play. The third bucket I would play is capex, much like you said, Sajal bhai. In capex specifically, I look at companies where the setup of the capex and the monetization of a capex has a 2 to 3 year gap. So there are certain segments, certain businesses where, once you do capex, you can monetize it the very next day or the very next month or the very next quarter. And there are certain segments like pharma and chemicals and many other sectors, defense, etc., where once you do capex, the monetization might take, good 2, 3, 4, 5 years. What happens in that period of 2, 3, 4, 5 years is very, very interesting, because you have done the capex and the opex begins, your balance sheet size goes up, because capex mostly comes from debt or it reduces cash. So your balance sheet size actually expands once you do capex. And because the opex begins the moment capex is complete, then your P&L also gets depressed and there is no corresponding revenue. So your ROE falls from two sides. One, your profitability falls, and two, your balance sheet expands. So your ROE takes a double hit. And the opposite happens the moment you start monetizing the capex. Your balance sheet starts getting lighter because you use the cash flow from the revenue to pay off debt, and your margins expand, your profits expand because the costs have already been there. The fixed costs are already there. Incrementally, you just, make the variable cost and you make the revenue. So most of your revenue anyways flows down to the EBITDA. So I try to identify stocks and businesses where capex takes a 2, 3 year gap to get monetized. Mostly happens in pharma, it happens in defense, it happens in many other sectors where there are basically regulatory approvals involved. The fourth bucket, so IT, consumption, capex, and the last bucket is tech and telecom. So telecom, more specifically, I think, Indian ARPUs seem to have bottomed out, and ARPUs are generally trending up. So if ARPUs continue to trend up, most of the, again, incremental revenue from an ARPU uptrend will flow down to the bottom line. Yes, there is a pending auction, and, balance sheets might take a hit when the auction happens, because most of these companies will probably take debt. But you don't need to play the frontliners. You can also play the ancillaries to these frontliners. So supply or, support these frontliners. They don't have the spectrum bid or issue, and hence don't have the debt challenge to their balance sheet. So, some part of that pocket is also looking interesting to me. Last but not the least, some of the healthcare companies are also looking fairly interesting. Healthcare stocks, FY21 to 23 was a very bad patch. Margin compression was horrible because of higher raw material prices from China. FY24 has seen some reversal of the margins, but not all of it. Remember, most of the healthcare companies tend to maintain very high inventory, 6 months, 12 months inventory of raw material, because they don't want to be stock out. And hence, they have high priced inventory for most of FY24, which they were consuming. FY25 would probably reflect the lower cost inventory, which they had bought during FY24, and they will use that inventory in FY25 for manufacturing, and hence gross margins should continue to expand materially in FY25, in my opinion. And that is where. So these are the 5 buckets as a fund manager, I am bullish on, and I am thinking of putting capital to work at in these segments. I may also throw in one more, which is NBFCs. I think, given the RBI actions on the NBFC space, the higher risk weightage and etc., most of the NBFC companies seem to have been come off. They're trading at all-time low valuations, if not close to all-time low valuations. And I think India still is a financial inclusion story. So the NBFC space is directly linked to consumption and the growth in MSME sector. So if you see the budget, upcoming budget and upcoming government policies as being slightly more populist, then, probably the MSME and the consumption story will pick up, and that would help the NBFCs. And that would happen regardless of what RBI says in terms of risk weighting, etc. So if the growth comes back and, if the NIMs continue to expand, credit growth is healthy, then, you might have a significant rally in some NBFCs as well. Yeah, so that's basically my outlook on the space.
Perfect. Thank you, Aditya. Prince, I think we can open it up for Q&A.
Right, sir. So that for our audience, like we have got 15, 16 questions in the comments, so we'll be taking that first, and after that, if time allows, we'll take few more queries from you. So IT and chemicals, sir, both of you have already discussed, but the question is like how we can be like readying ourselves as far as exposure to these two sectors is concerned. So this is the first question.
Exposure to chemical and pharma.
IT and chemical sectors. So
Okay, well, so they're very different, right? IT is having shallow cyclicality, is kind of both discretionary as well as non-discretionary, and chemicals as well to an extent, depending upon whether it's GMP or non-GMP. I mean, my honest answer is follow the template. So what are the key attributes that we look for in any investment opportunity? We aspire for a sustainable industry tailwind. So both chemicals and IT have this sustainable industry tailwind. Both are essential. So these are not a monsoon to monsoon kind of a story, right? So they are more sustainable sort of tailwinds in my opinion. Then once the industry tailwind is there, we need to hunt for resilient businesses, TC management. So TC being trustworthy, competent, and management having some sort of an energy or fire in the belly. We also need to look for low or at least reasonable valuation, and have some sort of a common sense to avoid hot sectors or hot stocks where the news flow is. If news flow is consistently bullish, it will be in the valuation inevitably. And at that point in time, a naive investor will buy something at peak margins and peak valuations, and then will pay the price. So 2021 chemical IPOs, classic example. Tattvichintan, just an example, right? Many, Rosari Biotech, they all came out with IPO around 2021, and look at the opportunity cost. I mean, someone holding Deepak Nitrite for 10 years is making a hefty dividend along the way. So that person is getting paid to wait versus someone who is buying an IPO at 2021. So have common sense framework. Make as many mistakes as you like, but don't play Russian roulette, as I said. So avoid mortality risk. But sector-wise, both are positive. I think we kind of included that. But follow the template, follow the process. Ultimately, you need the margin of safety across management, margin of safety across business, as well as margin of safety in the valuation, along with sector tailwind that is sustainable. That's how I would.
so
Yeah.
Aditya, yeah. So Aditya, on the same question, like if we talk about the allocation part, so how much allocation? I mean, obviously it is different for everyone, but If I talk about you, what would be your suggestion on that?
Yeah, so on the IT side, I am slightly overweight so I manage a diversified AIF for my clients. Um, in that, we are slightly overweight on IT today. I think IT's weight in the index is about 11%. We have about 12% exposure in IT today. But, we will increase that exposure with time. I think, so, in IT, you have product ER&D companies, you have ER&D companies, you have product companies, then you have services companies. So we are more bullish on the product and ER&D side. I think that's where there is significant money to be made given where the IT sector is today. Um, and on the services side, yes, if you get a deep value name today, like let's say, for example, an Infosys, so when the discretionary spend starts in US and Europe, and if the rupee sort of breaks or depreciates, you can make good returns on stocks like that. So I would definitely be overweight on IT today, and increase that positioning over time as we get more evidence of some of these themes playing out in IT, which includes cloud, SaaS, yeah, even AI/ML, and other stories like that. On the chemical side, I'm extremely bullish on agri-chemicals. I think the price is right. And the earnings are probably at a bottom, cyclical bottom. Next 2 to 3 years, you might see a cyclical up swing in the agri-chem side, which would help us make good money. See, the holy grail of investing is to find stocks or businesses where there's earnings growth and the potential of multiple re-rating. I think that's exactly where agrichem stands today. So agrichem, I'm extremely bullish today, and extremely overweight as well in the fund that I manage. On the commodity chemical side, I'm very, very selective. As a space tends to be very, very cyclical and tends to be fraught with Chinese competition. So need to be very wary of, how that plays out. So very selective on the commodity side. On the spec chem side, if you can find value, I think the challenge is spec chem is not business visibility and growth and margins. It is actually value in the stock. So if you can find value in spec chem side, why not? But I struggle to find value in any spec chem story that I've evaluated. So I have thus far stayed away from it.
All right. So PSU more or less Sir has covered, but defense and railway, if we talk specifically, so is there any more juice left to these two pockets? And do you believe the momentum as we see in the recent past will continue since the government appears to be stable at this point in time?
So juice as in the business sustainability, yes, they are both a sustainable theme. There potentially could be a quote unquote CDMO type opportunity across railway and defense, right? So you made to order, or you start supplying component to global players. So you develop the customized sort of product. That's why I use the word CDMO. That can potentially start to play out at some point, but I think in certain cases, so I've seen valuations as high as 14 times price to book, or 10 times price to book, where the starting base was somewhere around 2 times price to book. So that's kind of pricing future 4 or 5 years out already. So there may be time correction, there may even be a price correction, or a combination of both. So as long as you find good value in these pockets, they they are still relevant. Someone who bought them about 2 3 years back, there is absolutely no point in trying to be over smart by selling. Just enjoy the dividend yield on your low invested capital, and just ride it out and see where it all goes. I mean, no one knew where the chemical theme would end up, right? Everyone was thinking that it's a flash in the pan when it all started. And I bought Deepak Nitrite, very late rather. So 2016, when Deepak Nitrite was already a multi-bagger then. So I bought it somewhere around $84, or when this phenol and acetone thing started, and they were planning to come out with sort of a QIP and fundraising program. But then it was already a 10 bagger over the last 2 3 years. So I was already buying a multi bagger, and I still have made a lot of money. Again, because of betting on the right management more than anything. So, and then you don't have to do anything. I mean, Just ride it out and let's see where Deepak goes over the next 5-10 years. I've seen Lonza, right? I mean, where they started and where they are today. It was a commodity chemical company. So again, sky is the limit, so to speak, but again, not a recommendation. Everyone has got a different sort of capacity to suffer, maybe having different capacity. But otherwise, yeah, the CDMO thing can still play out in railway and defense. Who knows?
Aditya, have you got any, exposure for your clients or maybe in these pockets and specifically like the companies which are providing credit to the, say, the power companies or maybe the renewable companies or kind of PSUs? So do you believe those pockets also have some value or as I was saying, they have already discounted 2, 3 years down the
So
line?
you're talking about financiers to renewable energy, etc.
Yes, yes,
Okay.
yes.
No, so we haven't taken that exposure, to be honest. We have gone more with secured lenders, and in the NBFC space, more with consumption-driven lenders. The reason being, we believe any new renewable energy or, EV or whatever you call it, different types of new technologies that are coming up, we don't have a clear sense of what type of technology will win. Science and commerce put together will decide which of these technologies end up winning in the future. And in the absence of a clear winner on that side, if you buy an ancillary to the uh, potential sort of candidates, and if your candidate fails, then you have a problem of NPAs and you have a problem of credit growth eventually, and a lot of other issues. So because of which we have stayed away from the space. I know it's glorified. I know it's sexy to invest in that space. Uh, but we are all about risk reward. We are less about the glorification of it. So we have stayed away. So we will let the commerce and the science take the call, and then maybe play a lower risk reward bet than what they are today. Today they seem to be very high risk reward bets.
Right, sir. So another question is on the domestic appliances companies. So the question is view on these companies as institutions are holding a good chunk in these companies, and even they added in the last quarter. So the companies of the likes of Whirlpool, Eureka, Forbes, etc., etc.
So again, it's a wrong mindset to track in what institutions are doing or what the fund managers are doing, what they are churning, which sector they are adding, which sector they are reducing. Because, and I'm talking from the perspective of a retail investor who has got the liberty to invest in micro caps and small caps as well. So why you need to copy the fund manager? Because fund manager is the goal or the aim of the fund manager is to run faster than their brother or run faster than their friend and not run faster than the bear. Whereas your goal as an individual investor is get into, a net margin of safety type of an asset, ideally a small or micro cap, and then ride it out over the 10, 20 years as long as the thesis is intact. I mean, yes, there will be 40-50% drawdowns along the way. So Newland was a 50 crore market cap company in front of my eyes when I first initiated, right? Today, where it is, and how many 50, 60, 70% drawdowns have happened along the way? Same for RPG Life Sciences, right? So get out of this mindset of chasing the fund manager. No one is smart. Majority of fund managers, they fail to beat the index. Why you think they are smart? Why do they fail to beat the index? Right? So people act smart, but they are not. So that being said, consumption, I'm bullish, as I said. Domestic appliances, discretionary consumption, it's a competitive space with low barriers to entry as manufacturing is largely outsourced. Um, so fixed costs on a category basis can be very low. So Havels can introduce a new category to take on an incumbent, and if it works out, it's all fine. They don't get harmed too much in experimenting and trying it out. So basically, competitors can attack your turf and each other with, and they can attack each other, and they usually do attack each other with almost no skin in the game. So in that sense, it's a kind of a Jurassic Park sector with relatively low barriers to entry. I keep evaluating ideas. I am currently evaluating two names, and I'm happy to share both of them in today's session. I'll probably share one right away, which is mainly into discretionary spending. But again, remember the caveat that you either have 100 hours to do your own independent due diligence on this company, or if you don't have the time, do not blindly clone, wait for 20-25% minimum drawdown if you want to clone someone, right? So don't just go and start buying. Um, and because these are discretionary, they are not into soaps, shampoos, toothpaste, that kind of stuff, but something that is linked to, liquidity and consumption that can be delayed but not eliminated. So India is getting increasingly polluted. People are getting increasingly health conscious. So something along there's a lot of chatter around the water theme, etc. So I'm playing water theme using Eureka Forbes as an example. They hired in my view, they hired the best CEO that they could have. Um, in the in the sort of Indian consumption, discretionary consumption universe. So Google Pratik Pota, if you don't know his background, and do some research, invest 100 hours, read through the transcripts, annual reports, build your conviction. And if you don't want to do that, then wait for 20-25% minimum correction and then see if it fits your template. Again, it's not a recommendation, but I just wanted to throw one name, which is non Colgate, non Dabur Chyawanprash type of consumption. Aditya?
So Aditya,
No, so nothing to add to what Sajal said. I think pretty much on the same page on this. The business seems largely, low entry barrier business. Yes, there can be moats when there is scale and if there are customer relationships, more importantly. But I think, a space which is difficult to find value in today in terms of what the stocks are trading at. So the water theme, as Sajal Bhai said, something like Eureka Forbes sounds a good one. But other than that, very very few names pass my valuation filter in this space. So staying away from it for now.
And one thing that I liked about Eureka Force, again, not a recommendation, they have one of the highest gross margin in the industry and one of the better cash flows. And they have only started the execution, literally, because there's a transfer of management and ownership that has recently taken place. But if you compare the gross margin of Havels with gross margin of Eureka, you would figure out what I mean. But anyway, next question.
Aditya, you were saying something?
No, I was just saying that we are staying away from the space because of valuations.
Right. So next question is on Netco Pharma. So Netco Pharma was and is doing the same play of targeting patent and so on. It never had the domestic strong base. Why is it not even getting its median P of 10 years even, which is like 33 and it's now trading at 13.1?
So I can go first, and Aditya, you know more because it's kind of closer to your heart. I think Natco Pharma is one example that we have almost on every spaces. I think invariably we have spoken about Natco Pharma. I tweeted again today my last year's spaces where I've discussed Natco Pharma. See, Natco is a business of few extremistan. So if you have read the book, you know what I mean by extremist son with examples and many disappointments in between. So Copexon was a rare positive event. Then after many years, Revlimid was another one. But these are like once every 5 to 7 year opportunities with no guarantee that they will come. So earnings will be very, 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 very lumpy in Natco, and that's the reason you can't discount. See, when you put a multiple to cash flows, you're saying that the cash flows are increasing. So yes, I can assign a multiple to an RPG Life or a JB or an Alchem or an Ajanta or whatever, but it would be very difficult for me to assign a multiple to something which is so lumpy that they may get a legal litigation down the road. They may not get a product approval. They may fail to execute the para 4 challenge, so on and so forth. So there are many challenges. Natco as a business is diagonally opposite of NCE CDMO. So Natco is challenging innovator IP rather than collaborating with them. And if you read my book, I mean, you know that my bias is clearly towards collaboration. or creative competition, not just challenging the innovator and the big pharma of US and Europe. Yes, odd lottery will definitely happen along the way, but then people will extrapolate a Copaxone that every year they will get a Copaxone. It doesn't happen that way. So that would be my honest opinion on Natcos. These are kind of, if you get them really low, use that for the next sort of extremistan. But when you get that extremistan, whether it's Revlimid or Copaxone, and market starts giving them a ridiculously high multiple, try to get out. Or maybe trim, if not get out, and then ride the remaining low cost as a dividend optionality. That's it from my side on Natco.
Yeah. So I actually I don't understand the logic of the question. I'll explain myself. So the first book on finance that I ever read, and the first line on finance that I ever read, was that the price of any asset is the discounted value of its future cash flows. Then I joined the asset management industry and the sell side, institutional equity sell side before asset management. And I learned of P multiples, EV, EBITDA, and I got confused. Which of is the book right, or is what the industry practicing in terms of EV, EBITDA, price to book, right, price to book, or whatever, are these right? And I eventually figured out that the industry is lazy and the book is actually much more rigorous. So look, P multiples and EV EBITDA multiples and price to book, price to sales, whichever ratio you talk about, these are all shortcuts. These are all shortcuts. Now we take these shortcuts and we talk about these shortcuts, assuming that we have done our exercise on the DCF, the discounted cash flow, earlier, and we know what the discounted cash flow infers as a P multiple or a implied EV EBITDA multiple or a implied whatever, P multiple, etc., etc. Hence, we, rather than talking in terms of DCF, because the DCF is difficult to summarize in 2 words or in one number, we generally talk about P multiples or EV EBITDA. It summarizes the valuation metrics in one. But that doesn't mean that that is the way to value assets. The way to value any asset is just a DCF, plain and simple, right? Now imagine, whoever has asked this question, I would request the gentleman or the lady to do a DCF of Natco. Okay. So Copaxone, whatever they are earning, let's say 250 crores of profit every year from Copaxone. And let's say they are earning 700 crores of net profit from a Revlimid today. Now you project that number 5 years out, or for the next 5 years, or the next 10 years, or a terminal value of that number. When you sit and try to do that, if you truly understand the space they are in, you will come up with questions like, okay, when will competition for Copaxone come? So in Copaxone, Biocon has a filing, Aurobindo has a filing, Dr. Reddy's is there in the space as a partner to Natco. And there are so many other companies that have a filing on Copaxone, but are just waiting for approval. As and when that approval comes, this 250 crores of profit for Natco can go to any number. It can go to 100, it can go to 10, it can go to 20. I don't know. Depends on the level of competition that comes. Same goes for Revlimid. Revlimid has a definite date after which there will be severe competition. So I think that date is sometime in 2026, March 2026 or something. And that's when you suddenly start getting tremendous competition in Revlimid, and whatever cash flow they're making for, or net profit they're making for Revlimid today will suddenly, evaporate to a 1/100th of the number, or 1/10th of the number, or 1/20th of the number. So you cannot give or any multiple, or because in a DCF, it will just be a 3-year cash flow. And no matter which stock you do DCF for, you'll realize the terminal value will end up accounting for 70 to 90% of the value of the asset. And opportunities like Revlimid and Copaxone will not even make it to the terminal value. They will die down before you can compute terminal value. So, please guys, PE multiple, the fascination with this number across investors is just baffling. I think this is a number that most retail investors have learned to use by listening to idiots like me who use these numbers as if, we know them like the back of our hand. Please understand that we have done the rigorous work of a DCF to understand what this number implies, and then we use these numbers, and we know when not to use it. So do not fall into that trap. It is a very dangerous trap. And see, The first rule of investing is not to lose money. How much money you make and whether you make money is the second rule. The first rule is not to lose money. This is a classical trap to lose money. Let me give you examples, okay? HCG, Healthcare Global, when me and Sajal bhai first spoke of it on any space, it has been 5x from there. And, HCG got 4x even before it earned a single penny of net profit, right? Max India is about 6x from where we first spoke of it. It still does not make a single penny of net profit. But if you look at cash flow, both of them are positive cash flows. So PE तो दोनों का infinity है ना. So infinite PE पे how do you value and how do you infer anything? So first, shift your focus from PAT to cash flow. Second, shift your focus from PE or EV EBITDA to DCF. Once you get so comfortable with your DCF for each and every company and each and every sub-segment, so to say, then you can start talking about the implied PE multiples and the implied EV EBITDA multiples. The starting point should never be a PE or EV EBITDA. Starting point is discounted cash flow. The first line in any finance book, in any investment book you will ever read is the present value of any asset is the future cash flow. In the same context, many people asked me, how do you value a pharmacy? How do you value a Zomato? I can't, because that line tells me anything that generates cash is an asset. Anything that requires cash from me every year is a liability. So why will I pay to acquire a liability? I will not. Yes, you can argue that today it's losing cash, 10 years down the road, 5 years down the road, it will start generating cash. Okay, let it do that first. What's the hurry? There is no hurry to acquire the asset while it's, consuming cash and it's diluting equity every year. Look at what happened to a pharmacy, a 95% markdown in the rights issue, right? Just imagine the shareholders who are stuck in a private equity holding paper which has been marked down by 95%, right? And so on and so forth for so many other stocks which are listed, Paytm, Zomato, the list goes on, right? So just be wary of these things. These are shortcuts which experts take because they have done the hard work to be able to take the shortcuts. If you are not an expert, you are better off doing your DCF. There are multiple models of DCF available online for free in Excel. Use them, understand them, and let me tell you this. The easier it is for you to project the cash flow of a company 5 years out, 10 years out, that company will trade at a higher multiple. And you will arrive at a higher multiple when you do the DCF of that company. And the more questions you need to ask and understand to do a DCF, a 10-year DCF of any company, the company will be at a lower multiple. That is the core reason why an FMCG trades at a higher multiple. And that is probably the core reason why metals trade at a lower multiple. I'm sorry I went on a rant, but it just baffles me. I'm so sorry.
Awesome explanation, Aditya. I must say, very relevant to the question and in general also. So the next question is, like in last couple of years, we have seen increased fire accident happening in the chemical companies. So how such event should be viewed from investor point of view? Is it viewed as a आपदा में अवसर और सावधान रहें, सतर्क रहे kind of situation?
Sajal bhai.
Right. Okay. I'll go on. Maybe next question you go first, Aditya. Okay. So, right. So the, आपदा में अवसर. The culture of safety and compliance has been poor in India. We know that, right? Let's be honest and accept it. So as a society, we probably don't value ethics over EBITDA margin. So if you have to spend money on compliance and systems and controls, you will naturally sacrifice EBITDA margin, and punters will hate that. Punters want fast money, pump it up, do some Twitter noise, create some volumes and exit. That's what punters do. And they don't like investments into the business because it kind of dilutes the EBITDA margin and the absolute EBITDA. So most investors play chemicals monsoon se monsoon tak, kind of trading. My biases are towards custom synthesis. If you could use the back end of the commodity, and if you can customize the product, make it made to measure kind of thing for the innovator or the customer, that's the kind of chemical asset that I am interested in. I may sound like a broken record, but see, cost of compliance is always very low compared to the cost of reputation damage, cost of cash loss, and remediation effort. It's just not on the chemical side. I mean, regulatory compliance should be embedded in the corporate culture. There is no other way. Very few Indian companies have a clean regulatory track record across chemicals and pharma, and I think that's good for the industry. I don't want everyone to be compliant, because then the industry as a whole will become very fragile. So, I mean, I explained that in the book and in previous sessions, that the fragile ones have to be punished, and they have to perish for the overall industry to stay robust. So in a way, non-compliance across chemicals and pharma is good news, because then it gives the level playing field to the good guys. That's how I take that. And Apada Mein Afsar is kind of the tornado model that I have explained in the book. So if you understand the business, if you know that management, so DBs as an example, right? If something happens there, again the stock and takes a nosedive 40-50% down, then you understand that management. It's an anti-fragile management. Especially Dr. Murali Devi, not the second generation. I'm not sure about them. But yeah, if I get a 50% drawdown in a DVs, I wouldn't hesitate. I will bet my house for sure. But again, that's a tornado, classic tornado developing. But otherwise, I mean, I'm not interested in short term 3 months punt, and then that's not my style.
Yeah, I think more specifically on the chemical side, these accidents happening, there are various obviously conspiracy theories as well, but I'll not get into them. So the conspiracy theories I have heard, again, I'm not supporting them or denying them, but I'm just saying this is what I've heard. Because chemical prices crash and some of the warehouses and factories have inventory which have been marked down because the product prices have come off. It's better to collect insurance money than to try to sell the inventory. Things that I've heard. I am not so sure whether these things are true, but you hear all kinds of things when you speak to 10 people. So rather than trying to sell the inventory, burn the go down and collect insurance. I think that's what people tell me. If it's true, very, very sad that that's the culture. If it's not true, then, thank God for that. Anyway, so the point is that obviously quality is an issue, safety measures is an issue. All that comes with a cost. Indian companies, parade in front of their customers as a cost-effective alternative. And if they start spending more on these things, then the cost metric sort of gets diluted to a certain extent. I'm not saying it becomes unaffordable. Definitely doesn't become unaffordable, and quality and safety should never be compromised with. But these companies sort of sometimes take these shortcuts in the endeavor to remain cost competitive for the customer and very profitable for their investor, which I think is a sort of a trap that they fall in sometimes. So I think that's what it is, yeah. And there's no other way than to choose the right management or the right people. And the best way to do that is to look at the track record of a company, right? I mean, how many fires, how many floods, how many such incidents have happened in the company's history. There can always be a first time, that will be an accident if it at all if it happens while you are invested. But, accidents can happen and it can ruin your investment thesis. That's fine. But it shouldn't happen because of lack of diligence. You should do your homework and sort of be sure that this company has not had many or multiple such instances in the past, and therefore is not definitely prone to it.
Yeah. No, that's wonderfully explained, Aditya. Thank you for that. Prince, before we take the next question, I've already shared one idea, and I promised I'll share nine names, or at least 9 names. So maybe I can take the next idea that I have some skin in the game, again with the disclaimer that you either invest 100 hours of your own sort of mind and effort into it, or you wait for 20-25% drawdown. So this is related to the turnaround tweet that I made earlier today. So Warren Buffett famously said that turnaround seldom turn, right? And we have seen loads of examples where investors got excited due to news flow, loss making business turning profitable, only to be fooled by the randomness, in the sense that they take it for granted that verse is over and permanently, verse is over permanently, and we can now sit back and enjoy. So Dishman Carbogen is one real example where past attempts to secure a sustainable turnaround have failed, always. Dozens of banks globally have attempted and failed to turn, including Warren's favorite Wells Fargo. I mean, look at the stock chart, right? Kodak to IBM to several other examples. So turnarounds seldom turn on a 10 to 20 year sustainable basis, and restructuring is what they keep doing, and they keep failing. They keep fooling the investor community with, the restructuring, and they turn around for a few quarters and then they go back to their old ways. So with that caveat, I'll share a few interesting examples around consumption. So I've already shared one previously in today's space on consumption. Again, mainly discretionary consumption is what I'm interested in, and also proxy to consumption. So both GMP and non-GMP chemicals, they are as a proxy to consumption, because regardless of which sector is participating in the global economic upturn or the domestic economy, chemicals are an essential ingredient. So those who have the book, they can see the graphic 7.1 and 7.3 and also 8.4. So I'm explaining these examples from that context. My template is simple. Know the industry, know the business, know the management, know what's sustainable margin for this kind of a business, and see where the puck is today. And then search for catalysts that can help those margins go north. And when the pendulum shifts from pessimism to optimism, you either trim exposure or you exit, depending upon, the valuation at that point in time and what other opportunities are available. So there is a good book around this framework called Zurich Axioms. I've tweeted many times this one. So if you haven't read it, it's a classic. You must read it once in a while to stay your memory refreshed. So with that sort of a background on turnarounds, and continuing with the consumption and proxy consumption, again, 100 hours or wait for 20-25% dip, don't clone mindlessly. The other one is the Pratap Snacks. I think, again, it's a busted IPO, and my weakness. I like busted IPOs stories, and busted IPO for me is typically 50% drawdown from the IPO price. So Glenmark Life Sciences, Supriya, when I first bought, they were 50% down. But I also look at the 15% opportunity cost of capital. So if something came out with an IPO 5 years back, and even if the stock price is flat, I can discount that intrinsic value, assuming I can see that, the gross block has improved and they've invested more. They're generating better cash flows relative to what they were generating the IPO time. So in that context, Pratap Snacks, I think, is looking reasonably well placed from an operating cash flow perspective, and the commentary that I've tracked in the transcripts and their annual report. So that's the second sort of a turnaround. And again, it's a turnaround caveat, right? Standard. But again, I'm increasingly bullish on the consumption and the proxy consumption. So that's the second idea that I can share with the caveat, right? And again, it's not a recommendation. It's just something to understand and learn that, how you play bottom of the cycle opportunities, and how you play how you play counter cyclically in an opportunity. When the valuations are low, you enter, and when the valuations are reasonable, you trim or exit. So now we can take the next question, and maybe Aditya can answer the next few questions to begin with, and then I can jam.
It's all the same, Sajal bhai, you go first.
Okay, right, no worries.
So can you please throw some light on SME stock beta drugs? It already applied for listing in main board and it might get listed in this month. It caters to oncology and have tie-ups with a lot of hospitals of the likes of HCG. Recently, it has also ventured into dermatology and also have some CDMO business.
Right. So I think, Aditya, you would know more. I've never actively tracked beta drug, but looking at the screener, right? And purely looking at the screener and how I look at it. So if I look at the fixed assets, I see beta drug at about 65, around that mark on the screener. So kind of gives me the impression that it's an asset light business, perhaps not backward integrated and purely into kind of a formulation. Because if I look at the gross margin, a branded business gross margin should be what, 65, maybe 70%. High quality asset, I think beta drag is having a lower gross margin than that. So that's something that you need to investigate. Gross margin in branded generic should be, I mean, typically give or take 65-70%, even when you're sourcing from a CDMO like Akums. So a lot of Indian branded generics companies, they are not fully backward integrated in the sense that they source their API or maybe sometimes even the entire finished product from CDMOs like Akums. That's another thing that I've observed on beta. Never actively tracked, and again, distribution of dividend, distribution of wealth. I don't know what their capex plans are and why they are conserving cash, but I mean, at least 10% of EPS should be shared with the shareholders, even if you are hyper growth phase with the shareholders. So I see the dividend distribution is slightly on the lower side, but other than that, I think the stock has obviously done well over the years. There is of course a lot of HNI interest in this stock, but I think that's all I could probably add on beta.
Yeah, I actually haven't studied beta in enough detail to comment on it, Prince. So I would excuse myself from this one.
Right. So next question is any decadal opportunity in biotech space within India, advanced enzymes, biocon or anything in CDMO that one can do SIP in? I know you have been negative on biocon due to debt, but they have reduced that recently. Not looking for a stock answer, so even sector view will help.
Right. No, thanks for feeding words into my mouth. The stock names, that is. See, biotech future is definitely all about biosciences. And when I say future, I'm talking about 10, 20 years, not next year or the year after. So that's the standard caveat. I like this space, and it's not the first time I'm saying this. So I'll give you an example on the industrial biotech behemoth, right? So Praj Industries, I bought Praj way back in 2014. Price was around $40, and excluding those erratic volatile moves, for next many years it was barely a doubler for me. And then COVID happened, and I think Praj was back to about $60 or something during COVID meltdown. Everything was crashing. So from 2014 to 2020, uh, from 40 to 60 at one point in time, I only made sort of a dividend in Praj. These businesses are very long gestation cycle. But then over a period of time, if you take a 10-year horizon in Praj, I've made a cool 10, 12 bagger, point to point, and with dividends. So I'm getting paid to wait here. And balance sheet is net cash. There is optionality in the business. I've been open in saying that it's an anti-fragile business. So my framework is with every dividend takes my acquisition cost lower and lower. So if I invested $40 in 2014 and I've had 10 dividends, I mean, my exposure or capital at risk is significantly lower, right? So I gain from the upside asymmetry, pure asymmetry, right? And I explained this again in the book as well. So that's been my sort of fundamental thesis. And again, I'm not thinking, I'll never think like a typical fund manager, because I don't have to report or chase the NAV. I need not run faster than my brother. I mean, I can play, a long 10, 20 year kind of investment, as long as the business is kind of evolving and management is doing all the right things, right? As long as this is not a Dishman Carbogen, I'm suffering. So as a family, we are. so I keep going back to that. But coming back to biosciences, Praj Industries is one. Uh, and you should you should maybe look at them closely. There's a long thesis I shared in 2021. It's on the SOIC. I guess if Mohit is listening. So we presented the biosciences space in 2021 April or May, and back end of that long session, I think about 4 hours, there's a 15-20 minute exclusive update on Praj. And I don't think much has changed since, other than the price, of course. So biosciences, as I said, is a very long theme, but next few years stocks like, advanced enzymes you mentioned, or maybe Biocon or Syngene, they will likely underperform. And they have been underperforming, right? Because it's a exceptionally high entry barrier business, but it's something that competitors will find incredibly difficult to enter. So if something was very easy, then India should have had 10 or 20 Praj. How many paint companies are there in India? And how many Praj are there? How many Syngenes are there in India? How many Biocons are there in India versus paint companies or consumer durables? So there is inherent entry barrier in this business, but that doesn't mean the space will start performing tomorrow. If you have a very long-term horizon, if your entry price is low, then these 3, 4, 5 names are good. Biosciences, as I said, is not an easy space to evaluate and hold for a common investor. Long underperformance. So point to point, I'm making to a 12 bagger in Praj plus dividends, but I've had periods of long underperformance, and I must have the capacity to suffer those periods of underperformance. But my performance I measure on a 20-year, 10-year basis, not on a 2-year. So you may be running faster than me. It's a marathon, right? So if you are running faster in the next lap, first lap or second lap of that marathon, and you claim victory, good for you. But I don't play that kind of a short-term game. But I think overall structure, India is just scratching the surface. There's a lot of outsourcing opportunity that will ultimately play out. There's a lot of biosecure thing, noise happening in China. Invariably, Indian businesses will get CDMO opportunities emerging in on the bio side. Praj, I think there is an angle of management change that will happen at some point. Because I'm not sure if Mr. Pramod Chaudhary will continue to run this business forever. So we will have to evaluate the business again, because management change, as I have explained in one of the lenses framework in the book, it's always a binary event, 0 or 1. So we'll have to evaluate again the opportunity, because ultimately 99% of the game is controlled by the leadership and the management. But otherwise, the space as a whole, I'm incredibly positive. Aditya? Especially on the Biocon, right? So you have been, we know your views on Biocon, but many who have recently joined the markets and probably listening, it makes sense to refresh their views, because quickly I can add, Biocon is not a pure play biologics. It's a combination mix of assets with high debt and a quasi holding kind of a company, right? But Aditya will throw some light on that.
No, so no one better than Sajal bhai to speak on Praj. I think good quality asset on bio side. Biocon, the problem that I've always highlighted is the asset allocation of the company, in my view, has been suboptimal. And I'm really scared to say that on any public forum, because, people there don't like it when anybody says that. But I think, they're betting on in the hunt of being a pioneer in the space. They have just gone too aggressive without knowing the outcome of the aggression, right? So when in a normal corporate, when you take a project, you have to explain to the top management what IRR are you expecting from the project. Now, in that IRR projection, you need to have a certain degree of confidence in what the products you are building, what kind of revenue they can, get you. And I think that's something Biocon probably got wrong, and by quite a margin, in terms of, what they were probably hoping for, and, what they ended up realizing in terms of revenues from their products. And to add to that, there was an overcommitment of capital in acquiring the actress, and that debt is just too heavy for them to service. There is also a succession issue. I don't know the second line after Kiran Majumdar-Shaw. Over time, I think Kiran Madam has got several, good quality talent in the company, but most of that talent sort of seems to churn after a couple of years, which tells me that, there's a difficulty in retaining talent in that company. And, that's one of the metrics we look at when we evaluate any company. It's easy to attract talent. You throw money sometimes and the talent comes, but it's difficult to retain good quality talent. So, on all those metrics, Biocon just doesn't fit my framework. And hence, we have stayed cautious on it. We have stayed away from it. And we continue to do so.
Prince,
The
we
next,
need to rush really. I mean, I've
yes,
got
yes,
about
yes.
maybe 20 minutes more. So how many questions are left? I think three, four, five questions are left, right?
Yes, yes. So decal question we can take a few weeks ago. You mentioned a company with price to book less than one
Correct, correct.
and the potential of yeah.
Yeah. So few days back, I tweeted that I took CAR-T as well, right? So those who follow the story knew what I was talking about, and so in that sense, it was a precision medicine targeted for a certain segment. I mean, 25x or 100x or no X. I mean, if last 20-year data is anything to go by, uh, the fragile thing has never compounded like, quality should, right? Is that not true? I mean, no one knows the future, right? It's a game of mistakes and probabilities. I mean, again, use the template explained for the innovator supply chain assessment, NC synthesis and management execution. It's not something that I can explain in a jiffy. But the coming back to Dishman, I mean, they have operations globally, from China to several countries in Europe and of course India. But where are the systems and controls to manage such a diversified and multicultural corporate footprint? That's the question, right? And I've seen them over the 20 years, right? They keep coming. Yeah, that's the other pattern that, and I think in recent Q4 earnings call, I was listening to that. People challenge that as well, and again, they keep coming with this new one-offs every other quarter, and the one-offs are one-off for that quarter, and tomorrow there will be a new one-off for that quarter or a different quarter. So this game of you know musical chair of one-offs. It kind of keeps running in a loop uh, with with Dishman. Uh, so I mean, management is the key thesis, right? And if you multiply any great opportunity, and Dishman is definitely a great asset, but you also need a great management to execute, right? It's not an easy business to run globally, and it has compounded at a very suboptimal. So if I give you a relative example, so I've explained DVs versus Dishman in the book. Maybe I can use a different example. So I've tried all of them over the last 20 years, and when I'll give you another example, a different one which is not there in the book. So Newland's market cap was just 50 crores when Dishman was already 5-6 times of Newland. So Dishman was at least six times bigger than Newland. So Newland was 50 crore, Dishman was 300, 400, 500 crore market cap business then. Um, if you look at the market cap, where these businesses are today over the 20 years, so Newland going from 50 crores all the way to where it is versus Dishman, whatever it has done from that 600 crore to I don't know what the market cap is today, but whatever, it is a very suboptimal compounding, probably lower than bank FD, right? And back then Dishman had a margin of 25% and Newland was barely 10%. So look at the transformation in case of Newland and look at the negative transformation in case of Dishman. Uh, so that's over the period. But if you simple check, if you go to screener, compare some numbers, it will give you some perspective on the corporate governance, right? Um, one very recent example, management declared results just 5 minutes before the start of the call. Literally, because they wanted no one to screen the numbers and quiz them. But the call got extended to 2 hours because people had a lot of questions and they pounded management this time around, and rightly so. I mean, there are institutions holding this asset, and of course, I mean, I could see that people were pissed off, and rightly so. But coming back to Dishman as a standalone opportunity, if you compare, so I've compared this with Divi's, I've compared this with Newland, maybe I'll compare this with Syngene, just to give you a perspective. You um, look at the cash conversion cycle of Decal, it's 450 days, 450, and Syngene is often negative cash conversion. Even last year was very low relative to even Divi's in case of Syngene, let alone Dishman. So cash conversion cycle is one number that I look at. 450 days. 450 days per Dishman is ridiculously high number. Uh, Again, a recent indicator of corporate governance, as I said, is declaring results 5 minutes before the call. Uh, Working capital days, again, 103 for Dishman, if I'm not mistaken, versus negative on average for Syngene. Though last year Syngene working capital was, I think, about 35, 36 days. Um, Again, balance sheet, high debt in Dishman, chronic high debt versus net cash for Syngene. So again, I've compared Dishman with Newland, I've compared Dishman with Divi's, I've compared Dishman with Syngene. I can throw in a Piramal Pharma, I can throw in Jubilant Pharmova. By the way, I've got a question for you, Aditya. Jubilant Pharmova is again slipping into this habit of getting, love letters from US FDA. So again, that's my take on Dishman, but I will pass it over to you, Aditya, for maybe just please help us out on your perspective on this crime CDMO space, with maybe include Dishman and Jubilant Pharmova as examples.
Yeah, well, I think, look, Bishman, I think you summed it up. I cannot add anything more to that. I think, it makes me sad. I visited the Bavla facility long back, must be 10 years now. That Italian guy was in charge. Highly impressed. I came back.
Mark Griffith, right?
Yeah, Griffith, yes.
Yeah.
And came back so impressed by what I saw. Looked at the numbers didn't make sense, kept monitoring for maybe 2 years, 3 years to see any improvement. Absolutely zero improvement, and I gave up. So thankfully never bought, because, our framework doesn't allow us to buy before we see improvement. It's okay if the price runs up a little. We are okay to let go of the upside. But we don't want to enter into accidents just because, something looks impressive doesn't mean it is impressive. There needs to be evidence of it being impressive. So never bought, but, wasted lots of hours, north of 100 hours, on the company, and then, eventually decided to stay away. It's not a waste. You learn every time you do something. So that's on Dishman. On Jubilant Pharmova, yes, you're right. Yeah, the company's compliance culture needs to definitely improve. First it was Montreal, now it's Spokane. Three observations. We don't know the nature of the observations. But yeah, to get observations at facilities. So, they many a times, these companies blame the Indian culture of taking shortcuts and whatnot, or valuing profitability more than compliance or safety. But look, it's happening in US, it's happening in Canada for them as well. So clearly not, a culture thing from the local workforce, maybe a culture thing from the top down. So they need to basically give higher priorities, and higher targets to their workforce when it comes to compliance. And, sort of make sure that compliance is not compromised in any way. So clearly a challenge, but again, a very good quality asset, and it's a conglomerate, right? So multiple businesses within that one entity, and some of those businesses are phenomenally good. I mean, you look at the Jubilant 4Q presentation, you will be surprised as to the amount of detail they have shared, and you look at the quality of disclosures that they have had is phenomenal. But yeah, none of those make up for the lack of compliance. I think that needs to be in place. It's something that deters shareholder wealth creation. It's something that deters customers to coming to them. It's something that deters, basically, ROCs and cash flows. So, absolutely not happy about them not sort of being strictly in adherence with compliance.
Yeah, absolutely. Before we take the next question, Prince, I can share a few proxy consumption ideas. Again, same caveat, invest either 100 hours on each of these, or wait for 20-25% minimum correction. So proxy consumption, as I said, is chemicals. But again, my chemicals, I like players that are moving or already into custom synthesis, CDMO type of opportunity. So, and they are at the low end of their business cycle. Majority of chemical X the IPOs. So IPOs are still not cheap, but majority of the listed space is kind of already very near to their business bottom. So I like in Jubilant Ingravia, again, Jubilant Group company, and they are getting very aggressive in the CDMO space, I believe, and they have, decades of strong chemistry knowledge. So they should be able to scale up the CDMO space. But again, it's a at least 4 or 5 year opportunity. It's not going to change materially this year or maybe next year. Another one, same old name, Nosil, right? So I attended this last call as well. Again, they're coming out with new capex again. Volumes are fine. Is the price realization, lot of competition, of course. But if there is traction in the autos space, naturally there will be tires and rubber chemicals. They are also forging new overseas relationships. Some customers surely reducing their China dependence and coming to Nosil, especially on the US side. Incredible fiscal prudence over last many years. So I've seen them over the cycles. At the top of the cycle, their balance sheet was net cash. At the bottom of the cycle, their balance sheet was net cash, throwing good cash flows. So overall, management has been very prudent in maintaining a good fiscal discipline. So that's another one. I'm still investigating this, but I think it's the bottom of the business cycle. There's a company from South India called Khemka Seminar. They are also moving into custom synthesis, I believe, and they've got good management as far as I have tracked so far. But again, these are all 4 or 5 year opportunities minimum. You need to do your detailed diligence, due diligence, transcripts, YouTube, Google actively, or wait for, a 25% drawdown from wherever they are today. So today, as in, is it 7th of June, right? And just don't blindly buy these proxy consumption stories. And I've got few more, but we can take the next question before. And I've got
Right.
5-10
So
minutes
view,
maybe, so I'll quickly wrap it up. Um, unless there is any sort of question, and we have not taken any audience questions, so I'm just conscious of the fact that we have not taken any audience questions. So it's up to you, Prince, if the existing question
yeah,
that
there are,
people raise is higher
yeah,
priority or the audience one.
right. There are few questions. I'll read it out. So, view on competitive intensity in the molecular diagnostic space in general and kit makers in
Yeah.
particular. So,
So I think
players like
it's a
3B.
question from you, Vineet. I mean, you know this space better than me, for sure. So I mean, I like this space, molecular diagnostics, and I play this theme via Thermo Fisher because that's one-stop solution across bio projects and services for me. And it also gives me diversification away from India because I don't want to put everything in a single currency, right? 3V Black Bio today, I mean, it kind of does not fit into my template because they are not doing any public calls, so it's difficult for me to assess the management, but the space is good. Also, I mean, valuation at 10x sales, I mean, I'm not sure how much optimism. The margins are good. Probably the 10x sales is justified. Probably, there may be some further uptick in the near term, but um, I can see you already know this asset better than anyone. So I would say follow your conviction, buddy.
So, next question is on Krishna Diagnostics. So, basically, he's asking whether it will get impacted with confusion in policy continuity in the current state of political turmoil.
Yeah. So on Krishna, I don't think so. So basically, look, healthcare as a subject is a state subject, and these tenders that these diagnostics like Krishna are winning, they are state tenders. They are not central government tenders. Yes, the funding comes from the central government through the NHM, and that is essentially a part of the budget which we have seen only expanding over the past few years. And I don't see the government of India, no matter which party or which coalition comes into power, I at least don't see any of them cutting the spend on healthcare, because that's, I think, one area where India desperately needs to spend a lot more than what India has been spending. And that's a well established, well known fact in all political circles as well as all economic circles. So in one sentence, no, I don't think there is any material impact that Krishna will see because of any change in political regime or coalition or single party government, whatever.
Right. So one question is on Indian glycols, in case anyone of you track that and like to
No,
take that
I think,
question.
yeah, I don't own this, but based on whatever little, I mean, chemicals is a space I'm reasonably positive. India glycols should also be a beneficiary of that. I think this space hasn't done much. Um, I've not done any sort of due diligence. I'm not invested. So, but my sense is, whether it's India glycols or any other business, my bias is, again, as I said, that those who are into getting into custom synthesis are already into custom synthesis. So companies like Atul, SRF, even DMCC on a micro cap basis, companies like Privi, they are also getting into custom synthesis, or even a Fairchem. The margins, I mean, the business cycle is definitely at the bottom or near the bottom. So if you have got 3-4 year horizon, then I think these are some of the good assets to play. But one that I would like to particularly stress upon is, clean science versus Deepak nitrite. And there's, let me throw a very interesting data here. So clean science, raw material is phenol and acetone. That's for clean science, and they forward integrate that into complex derivatives. Deepak का core ही phenol and acetone है. They are all captive, right, in phenol and acetone, right? And now they are moving into clean tech, advanced intermediate. So I would rather be comfortable with Deepak, and again, I'm invested. It's not a current investment. I've been holding Deepak nitrate for donkey's years. But that was one reason I was never kind of bullish on clean science ever since it came out with the IPO. Because I saw that, the moat doesn't seem as sustainable as the asking valuations were. And I don't think it's on a relative basis, it's not, I'm getting better assets and cheaper today. So that would be my wrap up on the proxy consumption space. Again, anything which is going into custom synthesis or already into custom synthesis within chemicals, that's where my template works, as long as the business is at the bottom of the cycle. And I can position slowly, and I can wait for 3, 4, 5 years for the story to play out. That's the sort of my kind of signature trade in chemicals, especially. So maybe we can take one or two questions and from audience. Is there
Right.
any interesting one? Is that we have already not covered? We've covered a lot of sectors.
Yeah, we did. So Shilpa Medicare albumin, how do you think it
Yeah,
will
so
develop over
I've
time?
not been tracking Shilpa since 2014, if I'm completely honest. They were a pure play API asset, beautiful business back then. They kind of made all sorts of diversifications, added leverage, and then, the US FDA challenges as well. So my update is pretty dated. I've not been up to date with what's the story there currently. And I'm not sure if I could only own one or two API CDMO assets, I would go for Shilpa Medicare, to be honest with you. I mean, Newland is one asset that I really, really like, and I think not this year, next year onwards, the numbers will start speaking for themselves. So, I mean, again, on an opportunity cost of capital basis, I mean, Shilpa won't be my first choice. But I may be wrong. I've not tracked this closely in recent years, of course.
Aditya, quick input.
Yeah, same for me. Yaar. I haven't tracked Shilpa for a while now. Too many changes and too frequent changes to the business model. Something similar to Strides. So,
Yeah,
generally
exactly.
I generally avoid companies which change their business model so frequently.
Right. So another question is, so much capex is going on in chemical and pharma sector, but why the proxy like GMM, Pfaudler, and HLE Glasscoat are trading so low?
No, so these assets have had their day in the sun, right? So the chemicals last capex cycle was, and again, it's a gestation period. So the HLE glass code and the GMM would do well much ahead of the actual chemical sector revival, because they need to supply the hardware upfront. So the chemicals capex that happened 4 or 5 years back is not throwing cash flows today. So first they need to realize those cash flows, the orders that they placed 4 or 5 years back in the last cycle, the capex that they have got on the ground, but then they got hit by Chinese dumping and so on and so forth. So first they will unlock capital and cash flows out of the previous capex before placing a fresh order with these guys. So I think from that perspective, the low valuations are justified probably to an extent. So I won't be a bull in these assets for now, unless there is a fresh wave of capex coming from chemical industry, which will only happen after they start realizing, the capacities start filling up to 60-70% at least, if not more. So maybe we are a couple of years away from that kind of a scenario.
Yeah, again, completely agreed. Nothing to add.
So quick question is like in a portfolio of 30 stocks, how much one should allocate to pharma and healthcare?
Right. So eat what you like. I mean, again, follow the template, have a diversified asset base to begin with, and try to be globally diversified if possible. Hedge your currency risk and your geopolitical risk as well. I would keep minimum 12 months expenses as cash in the bank, first of all. Future is unpredictable, right? And have some gold, maybe 5% of your net worth, please. And then have some job or regular income on top of that. So maybe like running a shop or a rental income if you're not doing a full-time job. But then if you're doing a full-time job, then I would say don't do direct investing. If you are an HNI, go through a PMS, or through a mutual funds, maybe, and don't buy 10 mutual funds, have one or two diversified. Mirai asset is a good one. Again, they've not paid me for saying this, but that's a good one. I mean, S. Naren, I know, is a prudent capital allocator, so maybe something from ICICI. But yeah, Mirai, ICICI, those kind of mutual funds. I know Samir Arora Saab has also started mutual fund. Again, go with the good guys. Why do you need to invest your money directly? And if you have got enough capital, then at least have 30% exposure to healthcare space. If you are an HNI, have a PMS with Aditya bhai, right? And but not 100%. I would say 30% of your capital could still be in that healthcare dedicated PMS or a mutual fund. Because I'm extremely bullish on the longer term. India will slowly, is already getting age, senior citizens are increasing, and the future of healthcare in terms of affordability and accessibility is immensely great. But again, have a diversification first of all, and don't get into this habit of fire movement at the top of the bull market. I mean, if you want to retire and if you think that you're financially independent, wait for 2-3 years of bear market at least, and then reassess your cash flow situation.
Aditya, you have anything to say?
Yeah, I think, look, so there are two types of businesses that you can bet on, right? Businesses which have certain cyclicality and businesses which have certain secularity, right? So secular businesses, to my mind, are only two: healthcare and to an extent staples, consumer staples, and everything else is largely cyclical in nature, right? So I would
Absolutely.
say you need to divide. Even IT, for that matter, is a global cyclical. So you need to sort of divide your investment corpus within the secular and the cyclical. The secular can be more structural investments where you can stay invested over long periods of time. The cyclical can be sort of more tactical, and you can sort of try to ride different cycles through your cyclical investments.
So last question, sir, from the already taken question. So it's on sugar. So basically,
Hmm.
he is asking, would UP factories benefit as most area is irrigated versus rain dependence in Maharashtra and Karnataka, and the sugar
Yeah, again, so
consumption
no,
and
no. So I got
production?
the question again. यार ये monsoon से monsoon तक वाला theme है. Again, if you want to play sugar, go with the best management. So I gave two examples. Again, no recommendation. And they are not my relatives, so but I like Triveni and Balrampur there. But ultimately, it's a kind of a monsoon से monsoon तक. It's kind of a barsati medak kind of a trade where the government will keep kind of throwing surprises. So a random event can make your stock drop. So be careful, but near term, I think sugar should perhaps do relatively better than what it has done in the last, maybe let's say 6 months or so.
All right. So I scanned through the comments. So two, three questions we can take if time allows. So. So one is like any view on companies exporting to Latin American countries like Lincoln, Kaplan Point, or maybe barring the companies, how we can view the export to
No, no.
Latin
So I,
American
in
companies?
general, not specifically these companies. I like exports market in non-US jurisdictions. So Latin America, Brazil in particular. So any company getting Brazilian approval is perhaps a good opportunity. And then there are countries like that. So maybe a Canada. Anything other than US, I think is slightly lower risk, and your margins are pretty healthy. Even in Asian, Southeast Asia for that matter, right? So that I think is a good opportunity, as long as again it's a game of betting on the management and the valuation. Aditya, anything to add?
No, so I think these are branded markets, right? Most of Latin American markets, Mexico, Brazil, are branded markets, and then the economics are pretty much similar to what they are in India. And even within these branded markets, these Indian pharma companies have two models. One is that they manufacture and then they sell to a distributor there who runs a field force. And because the distributor has his own brand and he basically takes your product, you are sort of a contract manufacturer for the distributor. So then your margins and sustainability both are under question because the distributor owns the brand and he can switch his CMO whenever he wishes to, if he gets a better price from any other sort of facility which is also qualified by that regulator. Uh, at the same time, there are companies which have their own field force. So, for instance, Torrent has its own field force in Brazil. Lupin has its own field force in Mexico and Brazil. So then that becomes a pure branded play like they have in India, right? So that's, I think, the best business model to go for. Uh, I think in example, you said Kaplan and one more. I think Kaplan has their own field force. And hence, in that sense, Kaplan qualifies to be a good branded generic investment.
Right. So one question is on the consumption stocks. So what's the basis for bullishness on consumption stocks? Is it because of likelihood of lowering interest rates? Post-COVID discretionary spending has definitely seen surge as reflected in sale
Yeah,
growth of
absolutely. So,
hospitality
so,
sector.
so, so, bit of everything. I mean, lowering interest rate is a near-term sort of but even otherwise, Indians are getting more aspirational, more health conscious. So they want cleaner air, they want cleaner water, they want to be, they want to be they want to eat better quality food, drink better quality whiskey or wine or whatever. So it's kind of premiumization. And as the GDP increases, you become more health conscious. So again, you go for health insurance, you go for diagnostics more frequently than you would otherwise. So again, it's a mix of all those factors. And any country that where the GDP cross the threshold of round about 2,500 kind of a dollar mark, the discretionary spend starts improving dramatically, because you could only consume so much atta, dal, chawal, right? So that's the core thesis. But again, valuation and management, you can't go wrong on that one.
Yeah, agreed.
Aditya?
No, no, agreed. So basically, on the consumption side, it is lower inflation coupled with potentially lower interest rates. So lower inflation implies higher disposable income, assuming your salary or your income goes at a certain level and inflation is less than that. Add to that, if the interest rates also get lower, then if you are currently leveraged, your EMIs also go down. So there is a double sort of impact on your disposable income. While your EMIs come down and your consumption expense also comes down, but your income goes up. So you are able to spend more on things that you aspire for.
Yeah, thanks. Prince, any sort of disagreement in the reply with anything that we, because it's always good to learn a contrarian view. So is there anything which is kind of contrarian to what we have been speaking about across sectors, from IT to everything else? I would love to know, and maybe it gives us an opportunity to opine on that one, if there is anything.
Nothing so far. And one question more is left. I can read it out to you. So, how can we better understand the capabilities of a company like Indigene over and above the information in the RHP? Also, would ZS be a good comparison to Indigene?
So again, I think the simple time, give give time, right? Let them walk the talk. We know majority of the IPOs end up disappointing. I've seen Laurus disappointing for 3 years, but that gave a fantastic opportunity back end of 2019. I saw Narayana disappointing initially. I saw Glenmark Life disappointing initially. There are many examples. So again, let the management execute not just 1 quarter or 2 quarter, maybe over a period of at least 3 years, and then see, if they are able to execute, because they have acquired so many businesses. I want to see organic growth in this business. Any business can grow via acquisitions, right? But you have to, at some point in time, you have to show organic growth, and there are companies in this space in Europe. Many boutique CROs do exactly what Indigene is. So they're not monopoly for sure.
Yep, same point.
Aditya?
Same point. Nothing new.
So Aditya and Sajal, we close with your remarks on the election uncertainty, which is more or less like, as you always say, is an event, and in hindsight, it won't matter much. But again, is there anything specific or in particular you guys
No, I mean,
looking at, or
no. So absolutely not. Is continuity of government. Again, so look at the partners. I mean, Andhra Pradesh should do very well. We know what this TDP guys have done, right? So we know Chandrababu Naidu is his past track record. Again, it's the track record. So I think the coalition is not coalition, it's a pre-poll alliance, right? So it's not something that, jor tor se sarkar nahi bani. They went into the election with this kind of hand in hand. It was a pre-poll alliance, and people have voted on the basis of that pre-poll alliance. So it was always NDA rather than, BJP plus TDP or BJP plus other regional parties. No, it was a pre-poll alliance and continuity. I mean, how many governments have got third term in India? Strong anti-incumbency. अभी यूके में देखना इलेक्शन होगा 10 साल के बाद, लेबर इज कमिंग, you get a replacement every 5 years, let alone 10 years. I mean, this government, they've executed. That's the reason they are getting a third term. You like it or not, people have got all sorts of opinions. धोबी को तो राजा राम से भी प्रॉब्लम थी, तो वो तो होता ही है.
नहीं यार, यहाँ पे मेरा व्यू भी सेम है. आई थिंक द ओनली थिंग दैट माइट चेंज बिकॉज ऑफ द इलेक्शन आउटकम इज, एज आई सेड, you might see a slightly more populist, budget or slightly more populist measures in the offing versus you would have otherwise seen in the last 10 years. I think other than that, I completely agree that nothing materially will change. And ये भी मेरा एक hunch है. I mean, from what I am reading and from what I am understanding, not necessarily I will go right. In fact, many a times I go wrong only on these things. So let's see.
Right, guys.
right?
Thank you for your inputs, Aditya, and thank you, friends, for asking all those great questions. It helps me improve and learn your perspective, and And that's the beauty of doing these interactions frequently, right? No one is perfect, so we all learn from each other. So keep asking these beautiful questions, and hopefully we'll learn something on every spaces session. But yeah, thank you for your participation.
And thank you,
Thanks, Sajal,
Prince,
for
for
being
hosting
moderator.
us. You're always very, very kind and very, very generous with your time. So thank you so much, Prince.
Thank you guys. Good
Thank you
night.
for
Good night. Bye for
the
now. Bye bye.
conversation. Thank you.